Welcome back to EDS, and in this video we're going to take a look at why most option traders fail and how you can succeed. In a nutshell, the reason why most option traders fail is because they are buying options contracts and hoping that the price is going to do something. We are going to do the opposite, and we're going to sell the contracts, or it's also called writing the contracts. We're going to collect the premium that option buyers pay. We're going to collect that, and I'm going to show you a way where we can make money regardless of whether the market goes up, down, or sideways. So the first thing you want to do is pull up an equities underlying in your brokerage platform, and you want to just navigate over to where you can see a list of expiration dates. So the first thing you want to do before picking anything or looking at anything is we want to know which expiration date are we going to pick. How far out in time are we going to be before we do anything else? So the expiration date that we want to lock in on needs to be between 30 and 60 days out in time, and it also needs to be a monthly, not a weekly or quarterly expiration date. Now, right now, the only expiration date that actually fits that criteria is January 17th, with 30 days left on the contract. So now we can come over to our watch list, or whatever it is that you use to select what you want to trade. We just use a standard watch list, pre-made watch list, and we're simply going to filter out all underlyings that have an earnings event within that 30-day period of when we're going to be in the contract. This is because we don't want earnings to disturb a trade. An earnings event can increase volatility, mess up our deltas, and these things will have a negative effect on our P&L. Even if the market doesn't move anywhere leading up to the event, there will be increased volatility, which will have a negative effect on our P&L. Remember, our P&L is based on the pricing of the contracts, not necessarily underlying. So we also then want to filter out anything that has a low liquidity rating level, anything with, the broker that I'm using has up to four out of 4 stars. So 3 and 4 stars and above. Well, 4 is the highest, but 3 and 4 stars is where we want to be. This is because we only want to trade liquid underlyings. We want to be able to get in and out of positions easily. And the more liquid something is, the tighter the spreads are. And the spread is what you pay when you get in and out of a position. It's the difference between the bid and ask. So I personally, at this point, like to order my watch list from high to low IVR. IVR is IV rank. As we briefly touched on, volatility plays a part in options contracts. We're going to be selling these contracts, which means we're going to be short the contracts. Now, when you're short something, it means you want to sell when it's high and then buy it back lower. So, the higher the volatility, the higher the options premium. So we want to sell when volatility is high and then play the contraction. And volatility is mean reverting. So that's good for us. So we can use IVR to determine when IV is high on that particular underlying relative to itself, and then we can write some contracts on it. We also want to keep in mind the size of the actual underlying. Anything below $40, $50 ish is going to be a bit tough. It doesn't mean that you can't put positions on those underlyings, but we're going to show you it becomes more difficult to get the right strikes that you want and to be able to select the right deltas that you want, etc. So straight away, UAL is sticking out to me. It's trading at just under $97 a share. It's got an IV rank of 91.9, which is very nice and high. It's got an absolute IV level of 54.2. So let's just take a look at UAL. Just so everybody knows, we do not trade based on the charts. It doesn't matter what the charts look like. This is simply just so you can see a visual representation of what's happening. And also so we can see where IVR is relative to itself over the past year or so. So as we can see, UAL has had a nice run up. IVR is very high in comparison to where IVR has been over the past year. So this is a prime option selling opportunity. Now we can come over to our list of expiration dates, and we've already selected January 17th is where we want to be, which is 30 days out in time. Now what we can simply do at this point, this is now called the options chain. So this is now the options chain for UAL for the January 17th expiration date. And we're just going to do what we always do, which is very simple. We're going to sell one call and one put. And I'll explain why we sell one call and one put in just a moment. But we want to sell them anywhere between a 15 and 20 delta. This is the delta column here. So we've got a 22 delta at the 110 strike. It is just a little bit more aggressive, but because IV is so nice right now, I think it's okay to go a little bit slightly more aggressive than normal. We've got a 23 delta on the put side. So what that's done is we've basically created a range for ourselves by selling one put contract, one call contract. This is what the order looks like in the bottom left down here. And we've created a range. Now, as long as price stays within this range, we will be absolutely fine. Currently, price is at 96.53 a share, which is indicated or represented by this horizontal orange line. And if price stays where it is, we keep all of the premium. If price goes up a little bit, but not above 110, we keep all the premium. If price goes down a little bit, but not below 87.5, we keep all the premium. Now, what is the premium? The premium is this number here, 3.84 times by 100 shares, because there is a contract multiplier of 100 on equities contracts. Each contract controls 100 shares. So that means our max profit, or the premium that we collect up front, is going to be $384. And our broker is going to require just over $1,000 in buying power to open this position. So we are looking at a very, very nice return on capital, especially for a naked position. And that is because of where IV is, implied volatility. Now, we've got a 67% pop, which is probability of profit. So that means we've got a 67% chance of making at least 1 penny on this position. And we have a just under 80%, 79% chance of making at least 79% chance of making 50% of max profit at some point between now and the next 30 days. So we're looking at between 67 and 79% probabilities of success. We are practically delta neutral on this position, and we've got a very nice return on capital. This is a textbook strangle to sell. And if you want to have even higher probabilities of success, you can simply just go out a little bit more. So we've got 15 delta on the call side, and we go to a 14 delta on the put side. And now we've got all the way up to an 87% chance of hitting 50% of max profit. 89% now. So, very, very high probabilities of success. And of course, you will collect slightly less premium up front, but that's because you're taking less risk. So if we just go back to the original position, now $1,000 might be more than what you want to allocate to any given position. So one thing you can do to reduce your buying power requirement is to get rid of this unlimited loss here. Because this is a naked position, this is a strangle, technically there is an unlimited loss. Now, you won't ever take an unlimited loss as long as you manage risk correctly. But if you don't want to have an unlimited loss at all, you can simply just buy another contract, go long on a contract a bit further out of the money, say $5 wide, and then you can do the same thing on the put side, $5 wide. And what that's done is has now defined our loss. The loss is defined as the difference between the two strikes, which is $5, minus the premium that we collect up front, which is $1.66, times by 100 because of the contract multiplier, and we get $334. Now, our broker knows this, and it only needs to hold that much in buying power because we no longer have an unlimited loss potential. So we've significantly reduced our buying power requirement by roughly 2/3. So our buying power requirement is now about 33% of the original requirement, this buying power amount should fit inside most people's portfolios relatively easily for the most part. And that's how you can find and manipulate positions to fit inside your portfolio. Everything is still the same. It's just that now we take less risk, we collect less premium on entry, but we take less risk and we have slightly lower probabilities of success. That's the trade-off for not having a unlimited max loss. Now, how do you know how much buying power you should be allocating to any given position? Well, we've put together a free position sizing template. The link is in the description. The way it works is you enter in the size of your portfolio and then enter in what the current VIX level is. I believe it just crossed 15 not too long ago, which is nice to see. And then everything below will be automatically calculated for you. And at this point, you simply just need to use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power to allocate to any single defined risk position, undefined risk position, how much of a portfolio you should be allocating to short premium strategies in general. And as long as you stick to this framework over the long term, you will be absolutely fine. If you want to learn in more detail about what we do and how we do it, link is in the description. This time, click on EDS Premium and get yourself signed up. Inside, you will have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, how we're making adjustments, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. And this allows you to learn the theory and see how it's applied in real life by watching our positions. You can use our positions as inspiration, or you can simply copy us. It's completely up to you. There is a private community, so if you get stuck, you could speak with myself directly, you could speak with other like-minded individuals and collaborate together and come up with new ideas. And there's also a 100% money-back guarantee. So after 6 months, if you have followed our trades and studied the full course, and if at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free. Right now, it's £1 a month to join. It's so cheap because we've just launched. The price will be increasing. However, once you're in, the price is locked in for life. So you are definitely rewarded for getting in early. And the aim of EDS Premium is to get you to a point in 6 to 12 months' time to where you can sell options contracts, where you can write options contracts, sell premium, collect premium, and to get you to a point where you could do that without any external influence or help. Okay, you're always welcome to stay in and be part of the community, but within 6 to 12 months, you should be able to do this by yourself, and it's a skill that you could take with you for the rest of your life. No one could take it away from you. So, with that being said, I will see you guys on the inside.